Welcome to Theo Trade. This is Don Kaufman, July 3rd, 2020. Doing the weekend update here on this Friday morning. Of course, it's a holiday weekend. And for that, put together a very special update here. Market strategies. What's working and what's not. Well, we're going to dig directly into very specific strategies. Everything from backspreads to in-out spreads, duration, and more. And we're going to talk a little bit about where I've had degrees of success and where I'm actually pulling a little bit of allocation from. So let's get right down to business here. When we start talking about strategies, and I've really listed a couple of them out, backspreads. Okay, now this is not necessarily in any particular order, but when I start focusing on the strategy session in terms of like what works right now, backspreads have been absolutely at the top of the list. Now, we actually use a couple of variations, if you will, of backspreads, ratio backspreads, volatility backspreads, anything that would be kind of construed, if you will, as an outlier strategy right now is working and working extraordinarily well. Now, I want to detail a little bit. Again, this is going to differ from a lot of weekend updates. We come in here, we talk about the S&Ps, we talk about the spider, talk about sectors, push all that aside. Right now, I think it's critical to understand, again, from a strategy standpoint, where you should be focusing and focusing some of your allocations. So when I talk about outlier strategy, I think the one of the best ways to kind of deliver that to you, I'm going to bring up the XLF, and I'm going to come in here and I'm going to click on auto expected moves. And the reason I'm going to use auto expected moves is to kind of delineate why outlier strategies are working. And again, this is of critical importance. The markets right now are, hyper into the outlier. What does that mean? Well, for the most part, if you look at these three lines, and maybe some people are not necessarily familiar with this, but this is what we term the expected move. All right. And is labeled to call it EM. And if an expected move here in the XLF, let's say, for example, says we're supposed to move up a buck or down a buck within a given week, literally we're supposed to move a dollar higher or a dollar lower. Now, there's absolutely no directional bias involved in expected move. And the expected move, and I want to also make sure everybody's on the same page, that expected move is derived, okay, specifically from, the options chain. So to kind of give you a little bit more detail over here, here's an expected move coming into next week, and it's about 86 cents, which is not exactly like, that's not spellbinding over there. It's an 86-cent expected move, neither here nor there. But the point that I'm trying to make over here in terms of what's working right now and, what's not, well, what's working, again, is the outlier trade. And the outlier trade is saying, like, look how many outlier events that we've had. Right. So I just zoomed into whatever, an esoteric, number of weeks, but outlier move. That move was inside. Here is I'll call that inside, but earlier in the week it was out there. Inside. Here's a huge outlier move. Okay. Huge outlier move. Huge. Again, look at the size of some of these moves that you've had. When I call them, again, outliers, it is outside the expected move. There are several moves in play here that are literally 2, even 3 sigma, which is like 3 standard deviations beyond where it was supposed to move. And if you're not quite getting that, as I said a moment ago, you're expecting this move of up a buck or down a buck, and all of a sudden, you get this, like a $3 down move or a $3 up move. That's what I'm talking about with 3 sigmas and so forth. And I wanted to show you here in the XLF, but it's not just about the XLF. All right. We can look through so many different products and see these outlier moves just again and again and again. Here's been a relatively, boring product, the energy sector. But again, even in here, some of the moves that have happened when they are outliers have been absolutely massive. So one of the things that we have been doing, okay, a lot of lately are these, quote unquote outlier type strategies. And for me, that's just going out there and doing something like a backspread where, I'm selling one of these, buying, for example, 2 of these. And that is, the backspread. And you look at it and you're like, well, it's not much. And what happens? What happens if nothing happens in the marketplace? And again, I bring up the XLE and I hit the expected move over here. So I have a bullish kind of outlier trade on, right? So I'm looking for an explosion to the upside in the XLE. First and foremost, I'm not necessarily looking, okay, for an explosion to the upside. If you looked at the trade that I built moments ago, it was actually done for about a 17-cent credit. So if the marketplace is to tank right now, I get to keep my 17 cents, right? No harm, no foul, no risk in that one. If we explode to the upside, though, we're going to be good to go. So there's just no question about it. Everywhere I look right now, and when I was coming through and looking at this, and I'm like, all right, market strategies, what's working and what's not. I'm not just pulling, a rabbit out of a hat over here. I actually went through and the last 60 days, literally the last 60 days, and I've had 220 fills. That's in this particular account. I've got a few more accounts in here, but as I started looking through, what's working, what's not, and so forth, going back, 30 days, 60 days. In all the different accounts that I've got on. By the way, this is just the last 30 days. When I was scrolling back through my positions and, what was I closing and what was I closing, really profitably? What kept coming up just time and again were these backspreads. I mean, it's the single most profitable strategy that I've had. It's actually in the last 90 days. The outlier strategies have worked out spectacularly. And I just cannot stress that enough. Now, for those of you who are like, well, listen, here at TheoTrade, just, bone up on the backspreads. We've done recent classes on them. Next on the list here, in-out spreads. In-out spreads. And I'll give you a quick example of in-out spreads. Here is actually an area where I'm actually pulling back my allocation. It's not that the strategy isn't working. Okay, quite the contrary. The strategy absolutely works. What I'm finding difficult, though, right now is the in-out spreads. Okay, the skew in the marketplace is making this extraordinarily difficult to put the strategy on. And that's what I'm talking about with implied volatility. Okay, the markets lately have just been a one-way ticket to the upside. I think everybody recognizes that. A couple of big down moves every now and again, but it's pretty much been a one-way ticket to the upside. And unfortunately, the volatility skew is making it difficult to build, bullish in-out spreads. So it's not that categorically speaking the in-out spread's not working. Quite the contrary. The in-out spread's going to work. It's going to work through volatility. It's going to work through not so much volatility. But it is difficult to place right now because if the marketplace wants to be bullish, it's kind of tough to be bullish with the in-out spreads. Hence my reliance, if you will, on backspreads. When I want to get bullish right now, and I'll just give you a quick example. I want to get bullish. I cruise over here to the XLF, and the XLF, you'll never guess what that is. It's backspread. It's backspread. And I got to tell you, in the XLF right now, I've got some size that I am trading in there in those backspreads because I got to get it done. And you're like, well, why? Why the XLF? Why the XLF? Well, it's pretty straightforward. It actually broke to the downside of the expected move late last week, and I have anticipation it may take a break back to the 2650. And if it does, I need some backspreads on there. So again, backspreads versus in-out spreads. I'm pushing more allocation to backspreads than in-out spreads. Next in the list. Oh, unequivocally, the most difficult positions to hold right now are duration positions. Now, duration positions, this is very different than, when I talk about option strategies and I'm talking about in-out spreads and talking about back spreads, the duration position, just hands down, it is an investment. This is not a short-term kind of stance. And every time I talk about duration positions, I use, my quintessential Boeing example. Let me knock off the expected moves and bring this back to 3 years. And again, I don't mind, detailing a little bit about duration positions. Duration position. When I originally opened up a Boeing position, it was right back here. That's right. It was early January of 2018. I held that position until effectively right down here. Okay. And it was right in the 200, 180, 150 level where I actually closed all of my Boeing. Okay. I held it through all of this, including this. Okay. I held it through it. And I want you to understand the duration positions. Okay. They are investments. This is not like you can actually think of buy and hold, but where people get, and misunderstand it is the duration position. I am using options, and I'm using options, not necessarily, it's the greatest trade ever. Could I go out there and short Boeing stock? Absolutely, but it would tie up a huge amount of capital. That wouldn't be too bright, right? Tie up huge capital. You can't do the short position inside of the IRA. Duration positions. Are they working right now? Well, let me give you an example. I am carrying, a short position and have been carrying a short position in Facebook. All right, and this is probably one of the more painful positions, and I'm carrying that duration position right in this neighborhood around 200. In fact, that's pretty much my inception is right around 200. Where are we right now? 230. I'm showing you a position that's literally going against me. And I'm saying, well, listen, this is a position that I'm planning to have on for an extensive period of time. That's why I brought up the Boeing position. To have an underlying move against me by what? $30. This is just still a nominal loss at this point in time. Am I going to continue to sustain it? Absolutely, unequivocally, yes. And the reason I'm bringing to your attention duration positions, because, you think about strategies. Oh, this is a strategy. Duration position, listen, I believe that duration positions are going to hold the most effective in terms of risk reward. I will also say this, in terms of net PNL in the last 3 years of trading, those duration positions have paid off phenomenally. And that is in very large part, though, due to the down move that we had in February and March. There's no question. We closed out duration positions in so many different products over here. And I'm just telling you, like, this level here in Facebook at the 200 level, I re-upped. All right. And I am short, okay, in a bunch of technology, including, of course, Microsoft. And Microsoft, yeah, you know what? I'm short in the 180, 190 region, and it's a runaway freight train to the upside. But again, these positions, you look at them, you're like, he's taking a hit in them. Yeah, except we believe that that'll probably be the greatest risk reward if and when the markets do eventually back off. There's got to be some sustainability, which is going to tie directly into keep your delta under control, people. Get your delta risk under control. All right, so duration positions, really straightforward. By the way, with duration positions, I think it's also important to kind of put some light on the fact that duration doesn't have to necessarily be short. That's my own bias right now. Duration positions, that could be, I went out there and I bought this stock and I held it for years. That's okay. I mean, again, it is a little bit of like the buy and hold. But the duration position lately, for me, has been almost exclusively on the short side. And I'm very forthright with this idea. When I look at the screen right now and I ask myself, what do I want to own at these levels? Like, honestly, be forthright with yourself here. What do you want to own in the marketplace at these levels? I mean, and own it for long term. Do I want to buy the spiders at 300? I'm like, no. Do I want to buy the XLF? I'll tell you what, the XLF, that's a better deal than most. I mean, things down 26% on a year-to-date basis. But the financials right now, they hate the financials. They hate me. But at the exact same time, I don't want to own them. Then, of course, you're going to come down to energy. The energy sector over the last 5 years is down some 50%. Appetizing? I own a tiny bit of energy right now. But again, I'm not opposed to long position. I'm just not. I get labeled in all the time. He's a bear. You better believe it right now. I am. And I'm actually going to talk a little bit about that here in a moment. But in my duration positions, they're predominantly short. All right, next one, buying irons. It's kind of a, unique and a little bit fun to discuss this because I grew up as a premium seller. I grew up around premium sellers, and I've always sold options premium right up until the point I bought it. All right, I am a big believer right now, big believer. You want to be predominantly on the buy side, okay? Of options premium. I'm on the buy side, which actually entails long gamma. And I'll give you just an example here in GLD. In GLD, I've actually got a position on where I've bought an iron, and those are my break-even points. Okay, and I'll continue. This is something I'm kind of doing on the peripheral, right? Like I'm not doing a lot of them yet. I'm still testing them out and so forth, but I've been buying irons and making money on them. So again, specifically in GLD, I've got a trade on there. Buying irons, though, happens to be working. That's something, again, I'm putting together very definitive criteria for right now. Next on the docket, calendar spreads. It's kind of cool, calendar spreads. I'm going to come back over to the XLF. Why calendar spreads? This is something, okay, I haven't brought up in years here at TheoTrade. It's literally been years. The last time I was really knocking it out of the park with calendar spreads was 2016. Again, I do a huge amount of regression analysis about my own trades. You should too. If something's not working for you, you're like, I'm just going to do more in-out spreads until it works. Okay. But the calendar spreads, they're right on the cusp, I believe, of really starting to work and work well. So I was mentioning the financials a moment ago because the financials continue to have, if you will, Again, year-to-date percentage down 26%. That's wonderful. They continue to have these kind of outlier moves. But I also found interesting inside of the financials, and I like to use the financials as a little bit of a marquee product, for trading. It's also relatively inexpensive to be able to place trades. Here's the thing about financials. All through this, the fact that it's down 26%, year to date, did you realize that the IV rank, though, was like 19%? And what that basically means is, IV goes up and IV goes down and IV goes up, but it's all the way down there. Okay. So what the calendar spread allows you to do, and there's actually a cool study somewhere I have for this. There it is. What you're actually looking at right now is this is kind of a chart, if you will, of IV rank. And you can see it's at 19th percentile. So it's got implied volatility. Effectively, what we're saying is volatility right now is inherently low. So what am I doing in here is I'm actually buying vol. I'm actually buying volatility. And I'm using an out of the money put calendar spread effectively to do so. This does have a little bit of directional bias to it, but it is what it is, and fairly happy with the performance of this position thus far. I've actually done the 21 July SEP calendar spread, the 21 July SEP calendar spread, and that's something that, again, we're going to keep a close eye on. So right now, I believe that, backspreads, duration positions, calendar spreads are where it's at. Now, the next thing I wanted to cover in here, long short. By the way, with calendar spreads, stay away from call calendar spreads. The volatility crush is just going to be too large. You could have ex-dividend risk, So I am using predominantly put calendar spreads as what we term here at TheoTrade volatility bombs. All right, I wanted to clarify that. Now, long short. Long short is an overall, strategy. Long short is something that for the next decade or so, I believe we're going to be involved in very heavily. And what I'm talking about with long short is something I've mentioned just extensively, day in and day out here at TheoTrade and on all of these updates. The long short idea is, we're seeing capital rotations. And again, you use the XLF here as the marquee. Capital rotations, for instance, out of the financials. And if they're coming out of the financials and the market's still going up, then they have to be going towards technology. So we've actually had this unbelievable long short strategy where, anything long inside of the Qs, short inside of the financials, and the S&Ps are kind of skirting through the middle a little bit here, grinding very slightly higher. And I'm just using that as an example, but we've had this constant capital rotation. Everything from the energy sector, the financials, consumer discretionary, consumer staples, gold. It's been like risk on, risk off, risk on, risk off. But again, these rotations have been phenomenal to trade. That's on the short term. On the longer term, I believe that for the coming decade, you're going to have to understand long short, that there isn't going to be, this is not going to be a marketplace anymore where you're like, I'm going to find me the next Roku, or I'm going to find me the next Beyond Meat. I'm just poking fun at Roku. Came quite a ways off the bottom over here. But if you look at Roku, for the last few years in here, it's off the 20 level, shot to 170, or trying to find the next Tesla out there. Listen, there's always going to be high flying stocks. They're always going to be high flying stocks. But the reality is, to allocate your capital, you're going to have to understand a little bit about being long and short, and that's one of the reasons I talked about short positions, and duration. All right. Last but not least, in our strategy session portion of this weekend's update, get your delta risk under control. Listen, I am not here to tell you whether you should be long or short. Okay, I don't mind saying what my delta risk happens to be. Net I'm in the neighborhood right now of minus 2,000 SPY. Delta, and that's of course what they term a beta weighted delta. So I'm in the neighborhood of negative 2,000 spider deltas, which means if the spiders were to go down, I'm going to be very profitable. But the bottom line it doesn't matter what my delta risk happens to be. Anybody can recreate negative 2,000 deltas. What could you do to get that? Sell 4 E-minis. 4 E-minis is 2,000 spider deltas. That's great. But that doesn't mean that you can handle that amount of risk. Because if you look at this from a P&L variance standpoint, what can the spiders do? Remember, I'm short 2,000 spider deltas, but what can the spiders do? Let's say over the next 30 days, right? Let's bring this up. So over the next 30 days, and you talk about strategies, let's say that the SPY can move up or down $20. Now, people, That is an expected move. That's what you have to kind of like get it through your head. We're going to move up $20 or we're going to move down $20 inside the SPY. But that's what's going to happen. We're going to tag up here. We're going to tag down here. So I want you to figure this out in a very linear way. If I have 2,000 deltas and we can move up $20, you do a little math over here. You're like, are you willing to sustain that kind of risk? Because this is normal. That's what's going to happen. You should actually take this and assume a $40 move can happen in either direction. That would be a little bit of the outlier, right? And that's a lot of what we've seen. So with 2,000 deltas of risk times, 40 over there, you start to fathom some of the risk involved. Again, I don't mind at all taking, my own positions in here. Again, this is not exactly the perfect way to do it. But when you have 2,000 deltas of risk and you multiply it times 40, and let's do some quick math over there, you see it. Are you willing to risk $80,000 higher or lower? Now, I don't have that much risk because I've actually used a couple defined risk strategies in here. Nevertheless, I want you to be able to interpret to get your delta risk under control. Because if you're sitting there with 2,000 SPY beta weighted deltas, you got to ask yourself, okay, is an $80,000 loss plausible, okay, for you in your account? And for me, all right, that's well within it. But again, know your risk, people. That's how you can strategize. That's how you can sit here with duration positions and take a little bit of heat. If you can't take heat in this business, you shouldn't be in the business. And you got to understand that. You got to have comfortability with your positions. You got to feel warm and cozy with that position and be like, oh, like if I hear one more person in an email like, we're rallying and I'm short. Yeah, what you think was going to happen? Think the marketplace is going to just roll out the old red carpet there and just sell off the second you get short? Come on, okay? This is the time though, people. There is volatility in this marketplace. It's phenomenal. We're seeing all these outlier events. You have to strategize what's going to be right for you. If you know you're the person that's going to panic, don't hold duration positions. If you know you're a person that's really edgy, you can't hold those positions overnight, maybe you should be trading intraday, okay? But if you are going to hold positions, you got to get that delta risk under control. We have tons of sessions about getting delta risk. In fact, two-thirds of all course material that I have done here at TheoTrade are specifically about getting your risk under wraps, because that's how you're going to see degrees of profitability. All right. Enough of the strategies. The disconnect, asset pricing and Main Street. There is a huge disconnect that everybody's talking about right now, whether it's the jobs numbers, whether it's, the Fed. Okay, listen, the bottom line with marketplace right now, all right, it just doesn't matter what you think the marketplace is supposed to be doing. Okay, everybody recognizes right now we're in a recession that could turn even uglier into some kind of a depression. There are V recovery people. There are the non-V recovery people. But there's people looking at the jobs number. Listen, none of it is for anything. Okay, people are like, it's the Fed that's doing it. The Fed is screwing me. But then there's, of course, an entire faction of people now that believe retail clients have taken over the trading world and are running stocks higher. It just doesn't matter what do you call it? Listen, right now, the bottom line is we're stuck inside of a really, really tight range. In fact, I kind of want to bring this to your attention. Ever since we came pretty much above, this is a 2983 gravity point. We're once again in a really tight volatility channel. And we just came out of a tight volatility channel below this. It's very, very surprising. An extraordinarily tight volatility channel. The only movement outside of it was for a brief and fleeting moment. Again, I'm a 30-day, 1 hour. Be careful right now. Be careful. Forget about the disconnect. Literally push it aside. Now I want to address the disconnect because it doesn't matter what you think. When you talk about the disconnect in asset pricing and Main Street, that's fundamentals. And fundamentals may work, and it might work, but it's going to be a long-term call. On a day-to-day basis, doesn't matter. Okay, blame the quants. And I'm telling you, blame the quants. Quantitative finance over here has changed what you know about markets. And that's just, hey, it is what it is. It doesn't make a difference what you think the marketplace should be doing. It doesn't, there's no technicals in a marketplace where, listen, it could keep coming right up here to like 3150. We stop, halt, pull back, and so forth. I'll tell you, in terms of like levels, you want to know what's important right now? If we come back down, okay, in and under the 29.83, things are going to get wildly volatile net. All right. Right now, though, we're in a volatility channel, okay, up above the 29.83. The upper edge of this one right now is somewhere around like, the 31.50. And we are towards the upper edge, but we were towards the upper edge a multitude of times before slamming right back down to 29.83. But I think that the pivotal number in there is, again, if we get back into these gravity points, things are going to be wild in there. Which is exactly the next point that I want to make over here. The next major move in the market is going to be about magnitude. Be very, very careful. Okay, when I say be very, very careful, my warning to you, and this should be a little bit of a shot across the bow, okay, here's the warning. We have extraordinarily high correlations. What that means when I'm talking about correlations, I think the way to kind of delineate this to you, look at like the S&P 100. In an up day, we usually have like 90 stocks to the upside. In a down day, we're having 9,500 stocks to the downside of the S&P 100. The correlations are really, really high. When correlations are high, okay, it doesn't matter what you think about Goldman Sachs or what you think about, Lululemon or what you think about like Nike. I'll just give you a quick example with this. Like, look at something like Nike. Now, I wanted to mention Nike because they took a monstrosity of a loss. Their sales were hideous, just hideous. Okay, the stock traded down, but it didn't matter. It already bounced back to the upside. And anything that's come out with just hideous numbers, and I'll give you another example here. Here's some more hideous numbers. General Motors. General Motors released what they were selling, cars, that is, or lack thereof. I think it was down 34% year over year. Actually, it was better than I thought it was going to be. But does the stock look like it's been, negatively impacted here? All right. Yeah, it's down a little bit. Obviously, it should be down a little bit. But net, those numbers largely priced in. The point that I'm trying to make with this is it doesn't matter, again, what you think about what's going on, again, on Main Street. But I will warn you once again, it's going to be about magnitude. What I'm talking about with magnitude is simply in respect to the fact that if you take a look at something like the spiders, we're a little channel in being driven in the channel. Volatility is actually inherently low versus what we've seen, and volatility is kind of low versus some of the actual moves that we're seeing on the screen. I'm talking about, pricing in historical volatility versus implied volatility. So I believe because of the high correlations, because of the lower area that we're in terms of volatility. Now, a lot of people look at the VIX and they go, no, man, the VIX is high. Okay. Yeah, well, guess what? I'm actually using implied volatility ranks, and I'll argue this till we're blue in the face. Look, check that out. The vol is actually really, really low in terms of ranking, especially given all the volatility that we've seen in this marketplace. Things really backed off. You need to be afraid right now. And what you need to be afraid of is simply this. Because the correlations of the marketplace are so high, if we explode to the upside, it's going to rock you if you're short. Okay? If we rip to the downside, all right, and you're long, you're going to get killed. For those of you, if you're short right now, you got to use backspreads, okay, to mitigate the risks to the upside. If we explode to the upside, again, because it's going to be about magnitude. Magnitude, when I talk about it, is like looking at a distribution curve and saying like, people, we're going out here, we're going out here. There's going to be a magnitude size move coming. And it's due to the high correlations, low volatility. When we start to break out, it's going to be a monstrosity is what I'm getting to. Magnitude, monstrosity, use them interchangeably. There's really high correlations. Be careful. Last but not least, expected move. So the expected move, let's cruise over to the SPX. We crack through the upside of the expected move. Listen, we were expecting this past week. I'm just going to zoom this in a little bit tighter here. We were expecting last week, all right, about $101 move higher or lower. So looking for like a 101 move. And we didn't get it. Instead, we got $121 move. Okay. Great. All right. So where am I going with this? Well, the next week, which is a 5-day week. Remember, we just came off of a 4-day week. Okay. There's 4-day. We went into a 5-day week, and guess what? Coming into a 5-day week, they actually dropped the expected move to $80. That actually makes me really nervous, especially after seeing a $121 move. I caution you, don't fall to sleep. Don't tell me this is because it's holiday trading and so forth. I don't want to hear it. Right now, again, be very, very cautious in the overall marketplace. High correlations, really kind of low implied volatility this next week. You're thinking, it's not that much news coming out. Yeah, we're actually about to crest back into earnings. And people, It's when things are starting to get quiet, obviously, in summer trade here, when they get dangerous. Because the irony is, we're not seeing summer trade. Volumes, they're still there. Okay, the volumes have actually held rather steady. The liquidity of the overall marketplace, not volume, the liquidity. That's, market makers making bid offer spreads and so forth. Liquidity is incredibly fragile. Volume has been decent. Okay, volatility is low versus where it was. This is all the makings right now for a very large move. Be really cautious, again, the next few weeks. No one's looking for it, in the week after July 4th. Be cautious again. Be safe. Get the delta risk under control. Thanks, everybody, for joining us here at Theo Trade. Have a wonderful holiday weekend. Bye-bye.